Greetings and Happy New Year if you're viewing this toward the end of 2016 or early 2017. This is Gary Miller from Trusted Financial Advisors in Laguna Niguel, California. And over the next 40 minutes or so, we're going to be talking about what happened in 2016. We're going to look back at some trends that have been developing since as far back as perhaps 1900, and looking forward into the future to try to help you make some financial decisions that will be of value. Before we take a look at the economic background for the year overall, I wanted to look back at the performance for a composite of my clients' accounts over the past 10 years. Now, this has not been independently audited, but I can tell you that all accounts, current or past, are included here. We have tried to replicate the GIPS standard, which is the standard for the industry, to give an honest picture of our overall performance. Now, each client account is individually managed. Not all clients have the exact same objectives, but I do feel this is reflective of our capabilities and the value that has been added to our clients financially. What you see here is one of the more tumultuous periods in financial history in the United States, including one of the greatest recessions in our history. We begin with a $100,000 hypothetical investment in June of 2006, and we go through early December, almost the end of December of 2016. What you have here is a balanced account versus a pure investment in a stock index, the Standard & Poor's 500. And a lot of people do invest today in exchange-traded funds that are purely a reflection of the 500 stocks in the S&P. Now, our goal, as stated to every client, has been to capture the upside to the extent of about 80% for the stock market. We've never said that we're going to beat the stock market, but the idea is to capture most of it, but with half the volatility. We have come very close to achieving that goal. What you see here in the first couple of years is the investments going up pretty much at the same level in the same direction. And then we get to the beginning of the Great Recession, and you see a real plunge from the roughly $125,000 level. This is the blue line for the S&P 500 down to about a $65,000 level. You can do the math, but that's about a 50% loss of investment in a very short period of time. Now, in the red line, our clients certainly gave back, but they pretty much were back to where they had begun 10 years ago. And because we didn't go down into the hole as deeply as people that were too heavily invested in stocks, we were able to come back and be breaking even within basically a year and a half or so, and continue to beat the S&P 500 for many years until really 2014, when the continued bull market for stocks kind of overwhelmed balanced account performance. But overall, I think it's safe to say that we have achieved our goal of capturing 80% or more of the stock market performance, but with considerably less volatility. Let's examine a few indications that the U.S. economy is essentially healthy. And one of the big ones is total non-farm payrolls. This graph starts in 2007, before the housing crisis and the Great Recession began. It shows the natural plunge in total employees, and then of course the recovery, which has been rather remarkable and has actually exceeded the monthly rate of hiring that we have seen prior to the Great Recession. Now, in addition to higher employment, the overall wealth, or the feeling of wealth, that American citizens enjoy is a key to the vibrancy of our economy. And a big one, of course, is home prices. Middle-class people own their homes in the United States, and with the plunge in home values that featured the Great Recession, it's been a long time crawling out of that hole, but finally the value of the average home in the United States has recovered where it was back at the peak in about 2006. And although it doesn't say a lot about the value of an investment in residential real estate being that exciting, what it does tell us is that the average consumer is more likely to feel the so-called wealth effect, feel better about spending, better about their financial condition. I believe this graph is also very weighty and should be considered symbolic of a sea change that has happened in consumer attitudes. What you see here is that while it wasn't consistent, overall household debt, or the debt service, the interest that people were paying on debt, was basically rising from the late 1970s up to its peak just before the Great Recession hit. And then, of course, we saw this huge drop-off, about a 30% decline in debt service costs compared to household income. Now, that was probably a result of people losing their homes, their cars, their businesses, etc. But to a certain degree, it was also people suddenly deciding they were going to pay off their credit cards and were not going to continue to take on debt as if there was never going to be a dark tomorrow. I believe this is a generational change that has happened. If you think about it, the largest financial force or group demographically in the American economy, and by the way, in most developed countries, are older people. The baby boomers and people older than that do not need as much debt generally. They're not out buying their first homes, buying furniture, buying new cars, buying baby clothes, paying for college educations, all of those things. Maybe paying for college educations for the boomers. But overall, you have less demand for debt as people get older. But I think there's a psychological component to this as well. Remember that the older people of today have financially had two major setbacks over the last 16 years. First, you had the technology bubble that burst, and a lot of people had, I know personally people that were in their 50s thinking they could retire until that happened, and their 401k plans and their pensions, their IRAs all plunged in value, and it was back to work and forget any idea of retiring young. Then we had the housing boom. People were feeling great because their homes were soaring in value. And then, of course, that one blew up. And that was followed with a financial market sell-off, of course, in stocks. And so this older generation, at least, people say over 40, maybe over 45, have experienced two major financial setbacks. They no longer have the confidence in the future, perhaps, that they might have had when they were younger. And so they're extremely careful about taking on additional debt. And I think this is something that's going to remain a feature of the U.S. economy and the U.S. consumer. Now, while consumers are perhaps more cautious about using debt, that doesn't mean they're not going out and spending. And this graph that goes back to January of 2005 shows that retail sales, although they plummeted, of course, during the Great Recession, have come roaring back. If anything, they've been accelerating. And what this graph does not capture is the booming Christmas season that we've just had in 2016, which I understand is the best one since around 2005. So while consumers are careful, they are out there spending due to high employment, recovered home values, and a general feeling for most people, or at least a lot of them, that things are getting better. Now here's the question. I've shown a number of indicators and graphs that would suggest that the U.S. economy is doing quite well. And compared to where it was, let us say, 6, 7, 8 years ago, that's certainly the case. But how healthy really is the economy? For example, it's interesting to note that the Industrial Production Index has kind of tapered off starting in 2014. And a lot of people thought that the U.S. economy, having dug its way out of recession, was going to hit escape velocity sometime in early 2015, because basically 2014 was a good year. What you see here is that did not happen, and in fact, industrial production backed down a little bit. It's certainly not at recession levels, but people have been wondering, what happened to our recovery? Likewise, another similar kind of indicator, capacity utilization in the United States, seems to have peaked out again in 2014 and then has lagged back. In other words, there's empty shop floors, unused equipment, underemployed people in our economy that are a puzzle to people who thought by now we would have resumed a level of economic activity, something to where we were in 2006 before the Great Recession. Well, for many people, the economic recovery has been a real boon and has been evident. This is simply not true for all Americans. As we saw in the industrial sector, there has been a bit of a leveling off, and this has really hit what I call Joe Sixpack, the blue-collar worker, the guy or gal with a high school education, who is not highly technically skilled, who might be the cashier at a Walmart, work on a factory floor, be in some type of a service position, but that is not highly skilled. These folks have not seen the kind of economic recovery that many others have enjoyed. Now, this graph is very interesting here. If you look at the red line, this is showing nominal rise of median household income going back to 2000. And if we are to believe that, despite the sell-off, I shouldn't use the word sell-off, but the decline during the recession, which is natural, median income goes down, it appears to have climbed back significantly, like a number of the other economic indicators. But in fact, when you adjust for inflation, something I like to do with a lot of the things that I look at in terms of indicators of economic activity, what you see is that in real dollar buying power terms, median household income, the blue line, has just barely gotten back to where it was before the recession hit. And even then it had leveled out for many years. It's essentially what it was 16 years ago. And a good number of people, political analysts, believe that one of the reasons that the upper Midwest industrial belt, which normally votes Democratic in a presidential election, went to the Republicans, to Donald Trump, was because he promised some type of relief from this stagnation that many of these folks have been experiencing. And this is also reflected throughout the developed world. Interestingly, you see that even industrial powerhouses like Germany have seen a gradual but steady decline in manufacturing share of total employment. Even Japan has seen this. Spain, France, the US, the UK, Canada, etc. The industrialized world has less demand for factory workers. Where are these jobs going? Well, a lot of people think they're going to China, to Vietnam, to Southeast Asia, to Mexico, and that is certainly true to a certain extent. But an awful lot of them are going to automation and robotics. Now let's talk about investments in this economic background. First of all, I think it's useful to look at this very long-term chart of U.S. 10-year Treasury bond yields. And these are reflective of many, many costs in the U.S. economy, in particular reflective of things like mortgages, car loans, student loans, things like that. This chart goes back to 1953, and it shows that we had a gradual but steady rise of interest rates over a 25-year period or so into the early mid-1970s. And many of you watching this remember when mortgages were over 14%, when you could buy a U.S. Treasury bond briefly in the 15% range. I like to tell a story about a gentleman I was a broker at the time, but this was in the, roughly 1980, 81, and I had a 14% U.S. Treasury bond that I was showing him, and he was unhappy because a month earlier these things had been trading at 14.75%. Of course, he did buy it, and I think he was very happy a short while after, as interest rates essentially have gone down since then. We've certainly had some bounces, but as you can see, over the next approximately 30 years, we have had a steady decline in U.S. interest rates to all-time record lows seen this summer of 2016. What is very interesting is the chart below. Now, this is a much more recent chart. It just shows the last 3 years, 2014, 15, and into 16. And what you see is the opposite picture. This is the price of a U.S. Treasury bond going up while interest rates fall. There's a kind of a teeter-totter principle. When interest rates fall, existing bonds go up in value. But you notice that post-presidential election, there was a radical decline in the price of Treasury bonds as there was a rather radical increase in the yield on 10-year bonds. 10-year bonds went from about 1.75% this summer to approximately 2.6% after the election. And what is interesting is that this chart broke the red line, which is the 200-day moving average. For those of you that are technicians, this is often considered a very meaningful sea change in direction of an investment. So it is possible that we have seen the bottom of the fall in interest rates of the past 30 years. It's too soon to tell. Let's address the stock market in the year just concluding. It certainly began on a sour note. It was actually a continuation of a downtrend that had begun in 2015, led largely by commodity-sensitive, energy-sensitive companies. Much of this was based on fear that China was going to go into an actual recession. This was going to reduce the demand for goods, particularly hard goods and commodities worldwide, and it threw quite a scare into the markets. As that did not prove to be the case, and as the U.S. recovery began to sparkle a little bit more, we saw a recovery and the market actually achieve new historic all-time highs in July and August of last summer. And this was all despite the uncertainty surrounding the presidential election. Then, of course, with the presidential election, to the surprise of many pundits, the election of Donald Trump and the prospect that Republicans in control in Washington were going to significantly lower corporate income taxes sparked a remarkable rally which took the market essentially to the 20,000 level, both a new all-time high in nominal terms and even after adjusting for inflation in real terms. Now, this bull market run was actually presaged as far back as 2014. And I showed this chart at the time in our blog at www.trustedfinancial.com in June of 2014. What I was looking at here is this long-term graph. It goes back to the year 1900. And what it shows is the Dow Jones Industrial Averages, but then they adjust it for inflation. In other words, for buying power. So while, for example, today we're talking about 20,000 on the Dow, that 20,000 isn't the same as if it was 20,000 in 1930 or even in 1960. So we adjust for inflation, for real buying power. But what was interesting is if you look to the right side of this graph, you will see that there was I'm going to just highlight this, a peak reached here, which was the technology bubble. Then we had the great technology sell-off. Then we had another peak just before the Great Recession hit when the real estate market fell apart. And of course, this was our biggest bear market since really 1974 over here, and a doozy. But since then, up to 2014, we had gone up again to this level that had been tested twice, a little above 15,000, about 16,000. And right there, we see a little breakout. And that's when I wrote Over the years I paid attention to the inflation adjusted indexes, and basically what I was saying was that this was a really meaningful sign of further advances to come. Now let's fast forward a little. Now let's take a look at that very same graph. This is the Dow Jones Industrial Average from 1900 to 2016, but adjusted for inflation so that we see it in terms of real buying power. And you see that the two previous highs that were achieved at the peak of the tech bubble and then again just before the Great Recession, these are, if you're a technician, these are known as resistance points. Okay, the fact that the market failed twice at that level makes that a significant level. And this is over an extended period of time. And here we have it in 2014, as I showed in the previous slide, breaking that level and now confirming and going higher. And actually this graph is not quite accurate. We're now up to essentially 20,000. So this is a meaningful graph, and it suggests to me, and I'm a guy who's been a technician going back to the 1970s as part of my overall evaluation process, suggests that the market could easily get up into the 26,000 level before this run is over. Now that doesn't mean next week or even next month, but that before we have a really major recession again, we are more likely than not to get into the mid to high 20,000s, which really suggests a significant further movement upward for the US stock market. Now, not everybody agrees that we are in the throes of a continuing bull market. We've heard a number of economists opine that, well, price earnings multiples are too high, price to book multiples are too high, and above all, this expansion, this rally in the bull market, which just began in March of 2009, is now approaching 7 years in age, and approaching 8 years in age. And that historically is a very long bull market. The average bull market lasts about 3 to 4 years. This is true, but I did want to show you this graph that appeared in, I believe, the Wall Street Journal. It's not very good quality reproduction, but it shows that economies can expand for a lot longer than a lot of people think. In the United States, we had a 7.3-year run up to recently, but we had a longer one from 1982 to 1990. We had a still longer one, 8.8 years, from 1961 to 1969. And we had a 10-year run in the economic expansion from 1991 to 2001, which was the technology era. And some of our other major Western countries have had considerably longer runs. Australia went for 25 years. So to say that this is an aging bull market and it's really unlikely that it's going to go much higher is not necessarily the case, in my opinion. Okay, something rather dramatic happened, of course, with the election at the beginning of November. Not only do we have a largely unexpected new president, but we have Republican control of all three legislative and executive branches that create laws and, to a great extent, regulations. The markets have reacted very positively because of a number of statements, policies, and visions laid out by Republicans and the Trump administration, as best we can read them. The first and probably the largest is the clear desire to raise taxes, to lower taxes on American corporations. Currently at 37%, this is one of the highest corporate tax rates in the world, and it has been argued for some time that this has made it difficult for American corporations to compete internationally, difficult for them to reinvest efficiently, and that if we can lower those tax rates and further have a so-called tax holiday, which is to encourage American corporations that are banking money from foreign subsidiaries overseas, get them to bring that money back to the States because it won't be taxed so highly. This could be like an infusion of a great deal of cash to jumpstart or accelerate the current level of growth that we have. The other vision is that the banks, which many believe are overregulated, will be encouraged to lend, perhaps by a delay in or a elimination of requirements to increase their holdings of quality investments as reserves against outstanding loans. I didn't really address this, but monetary velocity, the rate of exchange between businesses and consumers, between businesses and businesses, which has been really stuck at a low level even during this recovery we've experienced, that might increase. And the end result, many believe, will be a significant increase in our gross domestic product. Now, I haven't addressed the gross domestic product, but it basically has been stuttering in the area of 1.5% to 2% all through the recovery. And this, many feel, is frustrating, and it certainly is not reflective of the glory days of the American economy, say the 50s and 60s, when it was growing in the more of the 3.5% to 4.5% range. Okay, let's talk in more specific terms of what this sea change that happened in November could mean. First of all, as I addressed, lower corporate taxes would be good for stock prices. It means that corporations have more profits after tax that they can increase dividends with, increase buybacks with, or hopefully make good decisions in terms of reinvesting that capital, plowing it back into successful enterprises, and thereby growing the book value of the enterprise, which is good for stock prices. Now, lower personal income taxes would also probably be a really good thing for consumer spending. It would allow people to keep more of the money that they make, and we would think that many of them would go out and spend at an increasing rate, despite the increase in consumer spending that was illustrated in an earlier slide. If promises to repeal Obamacare or the Affordable Care Act go forth, this could mean a reduction of taxes, particularly on the wealthy, who are surtaxed by an extra 1% to pay for Obamacare. Now, whether that will significantly help the economy is a question, because wealthier people don't tend to run right out and spend money on consumer goods, but most people feel it would be a positive overall, particularly for financial assets. If the new president is successful in discouraging American companies from moving jobs offshore, and we have seen some indications of this in the jawboning, for example, that he directed toward Carrier Corporation after the election, this could be good for American jobs. It could slow down the loss of blue-collar jobs and even of some technical jobs that have been going overseas. But on the possibly negative side, if in fact we go into the tariff regime that Donald Trump has spoken about and raise tariffs on imported goods to allegedly protect American industry, the fear is that we will have a repeat of what happened during the Great Depression of the 1930s, when we raised taxes and other countries retaliated by therefore raising tariffs on American exports, and overall exports and imports slowed down, leading to a great slowdown in the world economy. All right, this could lead to a recession, and if it's carried too far, even to a depression. Some industries may suffer if there is a inability to export jobs, or even worse, an inability to bring in skilled workers from abroad. One industry that's particularly worried is the technology industry, which is one of the growth engines of the American economy. They claim there are not enough technically qualified Americans to do some of the jobs they need, like writing code, and they have been bringing in technically skilled workers from places like India to do that work. Now, if this becomes difficult, this could hurt those companies. If in fact a labor shortage develops, if in fact the economy starts to boom, this probably will mean inflation, and a rise of inflation is something that consumers do not like to see, obviously. If the economy heats up too much, the Federal Reserve is likely to raise interest rates. The so-called bond vigilantes, bond investors who are very sensitive to having their investments denigrated by inflation, will demand higher interest rates, and this could hurt the bond market. Remember, when interest rates go up, the existing stock of bonds goes down in value. Also, rising interest rates, if it gets out of hand, could hurt the real estate market. And in fact, home sales fell a little bit in November, and many believe it's because of a sharp rise in interest rates that took place right after the election. One thing most people agree on is that Donald Trump is an unpredictable individual. He has been on many sides of many issues. Some of his positions sound more like Democrat than Republican, and he tends to shoot from the hip at random times, and this is something that generally financial markets are not too happy about. How sustainable is a potential boom, if we get it, under Trump and the Republicans? Let's look at history. This graph goes back to 1950. The blue columns show what the gross domestic product was in each quarter since 1950, what the percentage rise on an annualized basis was. And what you see is back in the 50s, we even had years of 8%, 6%, etc. But that steadily over time, as we've gotten into the new millennium, our growth rate for the economy has generally been under 4%. And in fact, since the Great Recession, when you see that spike down in 2008 and the big spike down in 2009, we've come back, but we've only come back to roughly a 2% level. A lot of people believe that it's going to be very difficult for a number of reasons, which we'll talk about, to get beyond roughly a 2% growth rate. One of the challenges is the national debt, which is a real threat to an economic boom. Why is this? Well, the government is going deeper and deeper in debt to pay for entitlements such as Social Security, Medicare, Medicaid support, veterans benefits, etc. These are becoming an ever larger part of the national budget. They're gobbling up portions of it, basically entitlements, national defense, and the interest on debt are making it more and more difficult for the government to fund its needs and make it more difficult for taxes to be lowered without causing major negative consequences for government debt. As we can see, government debt has been soaring, and in this graph, which goes back to basically about 1965, you can see what has happened, and it really began to accelerate under George W. Bush and then really took off even further under Barack Obama. Interestingly, I juxtaposed another chart, which is this one, which shows retirements in the U.S. Okay, what you see is a large parallel between what has happened during the Obama administration and what has happened to the number of retirements as baby boomers are reaching retirement age and coming in demanding their Medicare payments and their Social Security payments. How are we going to be able to solve that issue? That is a challenge to any government that wants to perhaps lower taxes and spark a boom. A further challenge is that the US dollar has been strong, and it looks like it's going to continue to be strong. Why? Many other countries around the world have much lower interest rates than we do. In fact, interest rates on treasury debt in Europe is generally negative. You actually have to pay them to park money in treasury debt. But in the United States, even though our interest rates are still near some of the lowest in our history, they are still high compared to what people can earn in Japan and in Europe and some other parts of the world. So money is pouring into the United States to gain from these interest rates that we are paying on our debt here in the United States. And that is pushing up the dollar value, which makes it difficult for American companies to sell products overseas. It raises the price of our goods. It also raises the price of commodities, which makes it expensive for businesses to buy raw materials. Okay, so these are headwinds that make it challenging to get the economy in the United States. There's another factor, and I kind of alluded to it earlier, and this is the behavior of older folks. We have a large portion of our population, probably over 100 million out of 350 million, who are either in the baby boom generation or older, And they do not tend to be wild consumers. They don't go out and change cars every 2 years. They're not out buying new houses, new furniture. They're not conspicuous consumers. They're more careful with their money. They are savers. So even if you lower their taxes, are they going to run out and start spending money? While we're talking about the older generation and their effect on the economy, we should also consider the next generation, the next big force. These are known as the millennials, people born generally between about 1980 and the year 2000. 90 million strong, an even bigger generation than the baby boomers, and we know how much the baby boomers affected the economy. Normally, as this group is moving into its 20s and 30s, they are becoming a more and more powerful economic force, but there are some other considerations that are unique to this generation. When their parents reached their 30s, which was roughly 1975 to 1985, these were the baby boomers forming households, buying homes, buying cars, etc. And the economy generally took off during this period. And we had higher inflation, but there was a great demand. There was this surge. They used to call it the pig in the python, as a kind of a visual image of this large group of people going through the population and going through their stages of life. This does not seem to be having the same magnitude of effect with regard to the millennials. This group, for one thing, is earning not much more than their parents, which is very unusual. They tend to be marrying later. They're not really in a rush to go out and buy homes. They don't seem to be having large families. And many of them are still challenged with debt from college expenses, etc. And to some degree, because the baby boomers have been forced to work later than the generation before them, the World War II generation, due to the fact that many of them don't have pensions or lost what savings they had during the dot-com bubble and back in 2007, 2008, and they're working later, there's not as much opening up in terms of job opportunities and higher earning opportunities for the millennials. So there is some debate as to whether these folks are going to spark anything close to the boom that their parents did. As we enter 2017 with a new president, a Republican Congress, which is considered generally friendly to business and to economic growth, a lot of people have been very optimistic, and as we saw, we had this big pop upward in the stock market right after the November election and carrying through into the last week of December pretty much. Is this justified? Well, we've talked about a number of cross currents in the economy. I would remind you of the graph that I showed earlier of the gross domestic product and how in the United States this has been gradually trending down, the rate of growth, to around the 2% level. Well, according to one well-respected source of economic analysis, which is Goldman Sachs, here's a recent projection of what they think is going to happen. They are seeing a big pop upward in the gross domestic product right here in 2016, and actually this was well underway before the election. They believe it's going to peak out sometime next year, maybe as high as 2.3, 2.4%, but then rather quickly peter out again and drop back to the baseline of around 2%. In fact, perhaps even below that. If that's the case, it may be hard to justify the soaring stock prices we saw late in 2016. So we've discussed a number of the cross currents affecting the economy. And clearly, as has always been the case, there is no certainty out there. We don't know what asset class is going to be the big one in 2017. And anybody listening to this has been around long enough to remember when real estate was booming and then it crashed, when gold was booming and then it crashed. We've all been through stock market ups and downs, etc. So as always, I am a big believer in keeping diversified portfolios and having realistic expectations. Underlying all of my investment approach are Warren Buffett's two very simple rules. Rule number one, don't lose money. And rule number two, don't forget rule number one. I hope you found this discussion to be of value. I hope you will find it useful in making investment and financial decisions in 2017. And this is Gary Miller signing off and wishing you a very prosperous 2017.